Okay, we are sorry for being late, but we are so happy to be live with you all for another episode of Wife Her Live. My name is Zemi Stewart. I am the founder of Wife Her, which stands for Wife Healed, Empowered, and Restored. And we are all about helping women to become just that, healed, empowered, and restored. And a way that we do that in our community is by having a focus of the month. And the focus of the month is all about helping women to grow. And so the premise is a whole woman can pour from a full cup and be everything that she's needed to be for herself, for her community, for her husband, for her kids, etc. And this month, our focus of the month is personal finances. And we did a fourfold focus. So, first, we talked about saving with Lakeisha Roll. Then, we talked about investing with Tiffany Cartwright. And now we are talking about wise borrowing with Arlene Deveaux. And I am so thankful to have Arlene on board with me tonight. She is a finance professional. And forgive me, Arlene, because I am sharing the PowerPoint, I don't have your bio up in front of me. So if
Okay.
you could just introduce yourself to the community, and we're going to just jump right in.
Hi, everybody. So I'm Arlene Deveaux. I have about 15 years experience in banking. I have been from the bottom to the top. So all frontline staff positions. I have been in lending. I've been in customer service. So I have acquired a lot of information and knowledge that can assist with this particular topic. I am very passionate about it because I find that a lot of people are not aware of little certain things that they can be more aware of when it comes to borrowing.
Definitely. And just a little housekeeping, you guys, you can drop live comments. We see them during the broadcast. If you have any questions, drop your comments in. In fact, please drop some comments now just so we know that we're not alone, that you're out there watching with us. And without further ado, going to hand it over to you. So, should I jump to the next slide?
Yes.
Great.
Okay, so we're going to start with a few key terms that a lot of you may be already familiar with. But I'm just going to give a little deep dive into these terms so you can follow along with the conversation really and truly. So you go to the next slide. The first term I'm going to talk about is down payment. So the down payment is your initial investment or payment towards the total amount required for a purchase. So that's whether you're purchasing a house, a car. Normally, you would hear the bank wants you to come up with a down payment. Some people don't really understand what that is, but in layman's terms, that is your personal contribution to the purchase. Okay, so the bank sometimes will 100% finance a purchase, but under certain circumstances. But normally, you're required to inject funds into the project or into the purchase because you have to have some sort of buy-in, some sort of tie to the purchase to keep the commitment basically. So, an example of this we have here is, for instance, most financial institutions require a minimum of 20% cash injection on the purchase of a home while lending the remaining 80%. Okay, so that is why when banks are looking into financing your mortgage, the normal amount that is financed is 80%. And so you have to come up with the 20% because this is your buy in, this is your commitment to the actual transaction. Okay, the next slide. The second term that we're going to talk about is loan term. Okay. Sometimes you may hear your loan officer talk about the term and you may not understand where they're referring to. So the loan term is the length of time that the loan agreement will be in effect for. So, for example, we have here a car loan is typically for a 5 to 7 year term, and a mortgage is typically for a 25-year term or 30 years, depending on what you can negotiate with your particular bank of choice. So the loan term is the time frame that you have the facility for. Okay, next slide. The next term we're going to talk about is maturity. Okay, so you may hear the term your maturity date on a loan. And this is the date that the final payment is expected to be processed and the loan is expected to be closed. For instance, a 5-year loan obtained on the 1st of March 2016 may mature or close on April 30th, 2021, depending on the payment due date. So sometimes your due date can adjust based on whether you're paid weekly, monthly, or on the 15th, 30th, or whichever date you prefer. Okay, but your maturity date is the date that the loan is expected to be done. A lot of time, though, depending on how you manage your loan facility, your maturity date may be the same, but the balance may not align with your maturity date. And we're probably going to talk about that a little bit later. We're just going over the terms so you can understand what we're going to be talking about. Next slide. Okay, so this one, you may not be able to see it too well, but this one is debt consolidation. Okay, so this is the process of combining all of your existing debt of multiple loans or multiple financial institutions into one single loan facility, making one payment on a monthly basis. Okay, so with debt consolidation now, you would have already have a loan, 2 loans, 3 loans, 5 loans. It doesn't matter the amount of loans, but you decide that, hey, you want to consolidate all of these facilities into one particular monthly payment at one institution. So the example is a little bit long, so that's why it's a little bit you can't see it too well, but I'll read it for you. So for example, Susie has a car loan at ABC Bank in the amount of $35.20 with a monthly payment of $161 per month at 5%. She has a personal loan from Too Legit Bank in the amount of $12,738 with a monthly payment of $415.17 per month at 9%, and a mortgage at WDB Bank in the amount of $82,069 with a payment of $770.39 at 7%. She decides to move all of her debt to WDB Bank, where her mortgage facility is, at a rate of around 6%. Her new monthly payment on her personal facility is now $278.89 for 6 years, therefore freeing up $297.28 per month that she can use to be saved or to be used for another purpose. So when you consolidate your debt, the real reason to do this is you are trying to free up cash to use for whatever other purpose that you have in mind, or to save or whatever. But at this point, you may feel like, okay, things are getting a little bit difficult and it doesn't make sense. You have loans all over the place and you just want to go to one bank, make one payment, and then also free up some cash for yourself. The next slide. The next term is refinancing. So it is very similar to debt consolidation. Okay, this is the process of replacing an existing loan with a new facility and possibly better terms for the borrower. So while debt consolidation can be looked at as the same thing as refinancing, when the bank refinances a loan, it closes out the old facility and replaces it with a new one. Okay, so this example here, if we're still using Susie could have opted to refinance a mortgage at WDB Bank and add the personal loan balances to her mortgage balance. By doing this, she would have slightly increased her mortgage balance to about $98,327 with a payment of $762.33 at 7% for 20 years. Susie now has a payment of $576.17 in access cash available monthly to save or use for any other desired purpose. So by refinancing her mortgage to pay off the personal loans at the other banks, she now has a slightly higher monthly payment, but no extra other personal payments to pay out. So that means all of the additional money that she was paying out, which is a total of $576, is now back in her pocket, now ready for her to use for any other additional purpose that she sees fit, really. Next slide. Okay, so these are some other terms. I did not type those out, but I'm going to talk about them very quickly with you. The first one is collateral. So I think most of us are familiar with this term. Collateral is any asset or property that the borrower offers to the lender as a way to secure the loan. So we would know, well, you may not know, but suitable collateral would be any land, house, business, building, commercial property, multi-residential property, anything that is of a suitable value in suitable condition, the bank can use as collateral to finance a particular project, request, purchase, anything like that. Okay. Your credit history, this basically is self-explanatory and it is very important because your credit history helps to impact whether you are approved for a loan or mortgage facility or not. Okay. The way you handle your current debt now is going to form a part of your credit history. So your credit history is if you have a loan 5 years ago, you paid off the loan as agreed. You get another loan 5 years later, you pay it off as agreed. The bank can see your credit history and see that, okay, this is a good customer. Your payment, your credit history is what makes you a good customer. When the bank is looking for good customers, it has nothing to do with your personal character or, you're a good person or you give to the poor and you donate money. Like those are all good things. But what the bank is looking for is someone with good credit history, good payment history. Okay. A co-signer. Maybe some people may not be familiar with this term. But I'm sure my friends in the Bahamas are familiar with this term. A co-signer is a person who assumes responsibility on the loan, but who will not take the title interest in the property nor occupy the property. So essentially, a co-signer is someone who will say, if Susie cannot pay, I will step in and assist Susie in paying these payments. I am a co-signer only. I am not the owner of the house or the car or whatever I'm co-signing for. I'm not the owner of it, but I am saying to the bank that I will help Susie in the event that she needs to make a payment. I will step in and be responsible. Over the years, the responsibility of the co-signer is, it's really more, it's as responsible as the person owning the property, owning the particular thing that's being purchased. It should be taken very, very seriously. And the co-signer has to qualify for the facility as if it were their own. And it's also noted on their statement of affairs or loan application. So this is something that has to be accounted for. So if you co-sign on a loan for your friend, and then you want to go, or a situation happens and you have to get a facility, you have to actually account for that loan that has nothing to do with you per se. You don't have any interest in the property or whatever that was purchased, but you're equally responsible for the payment. And so you have to handle it as if it was yours. The final term here, default. This term is maybe not so familiar for some, but default is a failure to fulfill the repayment promise as specified in the loan agreement. In other words, you default on a loan when you no longer make regular payments on it. Okay. And so when you default on a loan, normally the file is called a delinquent file. Now, people don't like that term, delinquent. I used to work in collections, and anytime that delinquent word was mentioned, people, it's like, I'm not a delinquent person, but it's just a term that is used to classify what the file is. It is delinquent. There's no payments being made, and you have defaulted on the loan. And so now different procedures have to be put in place. Okay. Next term, next slide. So right now, we're going to talk about strategies for reducing existing debt. I guess if there are no questions, I guess we could hold the questions until the end. So the strategies for reducing existing debt. Next. Okay, you could probably make this a little bit bigger. Okay, so the first one These are very simple. I just decided to narrow down 5 strategies for reducing your existing debt. And the first strategy is actually just honoring your original agreement, whether the payment is due weekly or monthly. Okay. So a lot of people think that you have to do all of this extra work to get out of debt. But if you look at the facility as what it is, and you just pay the agreed payment on time every month, you will probably finish quicker than if you were trying to do too much, right? So let's keep it simple. You could just honor your original agreement with the bank. Now, this can be difficult in times where there's job loss, in times where, finances are not exactly where it was. When you do that, you basically showing that, okay, you're committed to this agreement. But if it's seemingly impossible, this is where you have to contact your bank and make another agreement. Okay. The second one is make extra payments where permissible. Okay. Make sure you understand the terms of your loan. So, in some instances, you may not be able to make extra payments because you got into an agreement with a fixed rate or a fixed payment that also causes you to have a penalty if you make an extra payment. So, anything that is fixed means that there cannot be no extra anything. So there cannot be any other interaction outside of what the fixed agreement is. But anything that is a variable agreement, anything that is a flexible agreement, you probably have leeway to make extra payments, and you can determine the extra payments that you make. But I would suggest you not stress with making too much extra payments if you're not going to be consistent. Okay. The next one, you can ask your loan officer about loan sales or rate specials to reduce your monthly payments. So you can reduce your debt by renegotiating the terms of your loan. So a part of the terms of your loan is your loan rate. Okay. So the loan rate determines how much you actually pay. And if you get a reduction in your loan rate, then automatically your loan payment will decrease, which will decrease, the amount you're spending on your debt. All right. The next one is, if you feel like you're overextended, consider consolidating your debt into one affordable monthly payment. Okay, we talked about that earlier, and I gave an example on how you can consolidate any extra or existing debt into one more flexible and affordable payment for you. Now, when you do this, don't go back out there and start getting more loans. Sometimes some people are addicted to, just overextending themselves. But if you're at a point where you're consolidating so you can free up more cash for yourself, then this should be a commitment that you make in your mind, and you're sure that this is what you want to be more financially sound for your family. The last one is consider refinancing. Okay. If you have a mortgage facility if you have a mortgage facility with appropriate collateral, okay, refinancing, as I gave the example earlier, is a perfect way to kind of start back over. If you already have a house, you have personal loans, and you have other loan agreements elsewhere, and your mortgage facility has decreased significantly, you can say to your bank, okay, and depending on your age and all of these other little things, you can approach your mortgage officer and say, look, I really want to refinance everything. I'm going to consolidate and refinance my mortgage, top it back up to pay off all of my debt, and just pay one simple payment every month. And the bank would love that because the collateral is already in place. All they have to do is update the paperwork, make sure that you could qualify for the payments, and then basically issue new funds. That's like the best thing any bank wants to hear. You want to refinance? Okay, perfect. We already have your collateral. We already have everything in place. So it's just simple. Gone are the days where banks would just lend money unsecured. Like, they probably do it now, depending on your relationship with them. But it's not like how it used to be back in the day. Like when I first started at the bank, unsecured loans were going out like this, like hot potato. You could go to the bank and borrow $10,000, $20,000. But the financial climate is not like that anymore. And unfortunately, what other people do, sometimes the innocent has to suffer for the guilty. And so the rules and the regulations, the policies, everything is now updated and put in place to avoid certain situations and to avoid um, mishaps with clients. So unfortunately, that's just how it is now. Um, Next slide. Oh, we have a question. Would the term remain when, okay, so when you refinance, the terms doesn't necessarily have to be the same, but this is why you have to ask questions as well. Because some people do not ask any questions, and then some people don't ask the right questions. So before you sign any other agreement, you would like to know that your terms are actually better. So if your loan facility was a 10% rate and you're getting a rate reduction at 8%, automatically you know that your loan terms have improved, because the lower the rate, the lower the payment. So even if you don't understand the actual percentage or the calculation or the amount of money, as long as you know that the rate is decreased, the number itself has decreased, then it is better. Okay, if your rate has increased, then you know it's going to cost more. And that is the chance when you have a variable rate loan. So the variable rate depends on what the market is saying. So like here in the Turks and Caicos, we use USD. Our rates are determined by the New York prime rate. And so when New York prime changes, that affects the variable rates here. So if the rate increase, then automatically all of the loan rates will increase by whatever New York prime increases by. If it decreases, then that same decrease will be applied to the client. So that's another risk as well. So you have to calculate the risk in terms of, okay, do I want to have a variable rate and benefit from when the rates decrease, so I will have a lower payment at some point? Or do I lock myself in for a certain amount of time and the rate is decreasing for everyone else, but it can't decrease for me because I agreed to a fixed rate? So those are some of the things you have to think about when it comes to refinancing. Okay, so borrowing wisely. So here are some instances where I think that it's wise to borrow. You know, I'm not knocking anyone's lifestyle or anyone's choices in terms of what they choose to spend their money on, but I think that there is a wise way to borrow and a wise way to capitalize on any debt that you may have. Some people think that, you know, the bank is evil and, you know, and they're just trying to take your money, or the bank don't want to lend, but that's not the case, because I know it's not the case. Okay. The wise way to borrow is for big ticket items that would probably take you a lifetime or perfect circumstances to save for. For instance, the purchase of a vacant lot or home, even a vehicle can count, because sometimes saving can be difficult. Okay. The second option is for investments. If you're trying to invest in a business and this is going to improve your business activity, that's the next thing. And whenever you have suitable collateral to be to act as security for the loan facility. So you may have a piece of land that you probably want to develop, and your grandfather, grandmother, someone uh, gave you this land. And so you can use that land as security to now build something on that land. Though these are ideal situations where it is wise to borrow. And I say big ticket items because, you know, these are where you can see the true value in where you've invested your money. If you're only going on vacation, I mean, you're probably going to buy a few clothes. You're probably going to throw them out after a few months. You don't really see the value in a vacation loan, but you can see the value in purchasing a home, vehicle, and doing investments. All right. So interest rates, high versus low. I know it can be confusing because normal people don't talk about interest rates on their daily life. So we're going to talk about that just a little bit. So yeah, make this a little bit big. So Interest rates are the percentage amount in which the lender is charging the borrower for a particular loan facility agreement. Okay, so that is basically the fee that you're paying to borrow this money. When someone is given a higher interest rate, this is normally an indication that the risk profile of the individual is higher for the institution to take. Therefore, the higher the risk, the higher the rate that may apply. Of course, the rate will still be manageable by the client and the individual will still qualify for the payment. And so I have an example here. For instance, credit cards have a higher interest rate of about 18 to 21% because the risk that individuals may not repay. Okay. So credit card interest is very high because there's a high likelihood that individuals may not pay that facility back. Okay. So there's a lot of times where you have first time borrowers that will get a credit card, max it out, and never ever pay it back. Okay. So because the risk is high, the rate is high. Okay, anytime that the risk is higher, automatically expect the rate to be higher. Okay, lower interest rates are normally negotiated on larger facilities like mortgages and investments. Since a mortgage facility is a long-term liability, there's flexibility in the way the interest will be determined. Therefore, the higher the mortgage amount, the lower the rate can be negotiated. Okay, a mortgage, this is just an example here, right? A mortgage in the amount of 700,000 can be negotiated to maybe, let's say hypothetically, as low as 4% versus a mortgage in the amount of 150,000 may yield an interest rate of 7. Okay? Unfortunately, there's more risk and management associated with a smaller mortgage facility. However, the client can manage their debt better to prevent this outcome. And when I say this part, right? Let's say you have a $200,000 mortgage, your rate is 7%, and you want a lower rate. The only way that you can get a lower rate is by being a good client. Okay. So paying on time. That's first of all. Once you're paying on time, you're already a good client. But if you're paying on time and let's say you decide you want to go the extra mile and you set a particular amount, you want to pay $50 extra every month or $100 extra every month, and you're consistent with this amount. Or if you're not putting extra on the facility, you're actually saving this money. So if you decide that you want to save $50 every month on a savings account, and the bank can see that you're actually saving, you're paying your facility on time as agreed, then when you go and say, okay, I am looking for options, I want to know if I can get a lower rate. When they look at your profile, they can say, okay, this is a good customer. Let's see what we can do for this customer. Okay, you can't say Susie is getting 4%. Okay, and I want 4% because Susie is getting 4% and it's not fair. Okay, but I mean, Susie's borrowing more money. She's literally gonna pay more interest because her facility is more. Okay, so when you're looking at rates, it can get confusing because if the loan facility is more, the interest automatically is going to be more. So if you don't really understand the calculations, you have the conversation with your mortgage officer and say, hey, I'm a good customer. I pay on time. I save my money or I make extra payments. I'm never late. I've been with this bank for X, Y, and Z. Let's have this conversation. I think that it's fair that I could get a better rate. And that's all you have to do. Simple conversation. And I'm sure that once the bank can see that you have done that, you haven't missed any payments, or if you have, it's for a legitimate reason. And legitimate reasons can be subjective to what people's opinion are, right? But legitimate reasons would be loss of income or your salary was paid late, stuff like that. Not, unfortunately, personal reasons. It would have to be really, really, really a situation beyond your control of access to the funds. Okay. Next slide. Okay, so these are a few things to avoid that I can think of. Can make this a little bit bigger. Okay, so the first one is to avoid financial avoidance. Okay, so what I mean by this is that you should always know your financial position. This also means that you should always know what you can and cannot afford realistically. So this one could be a hard pill to swallow for some people because a lot of people know how much they get paid, but they really don't know how much they get paid, if you know what I mean. Some people know that they receive a certain amount of money, but when it comes to life, they're not aware of their everyday financial activities. So they're just spending, spending, spending and not budgeting, not making sure, okay, I have my rent, I have my utilities, I have my school fee or whatever for my kids, food, gas. You should know these amounts. And typically they don't really change. So you should have a full picture of what you can afford every month and manage your funds well. Okay. The second one is to avoid friends who operate outside of your wage limits. Okay. If you find that you cannot say no, just avoid situations where you cannot afford to participate. For example, vacations that you cannot afford to finance within a year. Okay. A lot of people have a culture of, all right, I need 10 grand to travel. But can you save 10 grand to travel? Realistically, maybe not. Maybe you don't need 10 grand to travel. Maybe you only need two. Or, you know what I mean? Be realistic with your finances, okay? Number three, don't avoid your responsibilities. If you have if you have lost a job or have decreased income, talk to your loan officer to explore your payment options. You can control your financial health and no matter the circumstances. And this is very true, okay? If you've lost your job and or you've got a salary cut or whatever, and you go into the bank and you explain the situation and you said, realistically, I can only commit to $200 a month. And your regular payment may have been $500 and you may not be making the full payment. But guess what? If you commit to say, I only can pay $200 a month and you pay that $200 a month, and when you get your better job or more pay, and you start paying your regular payments, you will have not been seen to be a delinquent client per se because the finances was outside of your control. But what was in your control was you were honoring your agreement to pay something. You recommitted to pay something that you could afford. And that is what the banks look for in clients. You still honor your responsibility, even, within reason. Okay. Number four, avoid quick fix loans. Okay. If you're already in over your head, once again, arrange a meeting with your loan officer to consider consolidation or temporary interest only payments. And so, temporary interest only payments is an option that I think a lot of people would have experienced going through this pandemic, because this has been an unprecedented time where, globally people have lost so much income, so much access to income. And so a lot of people probably had to say, okay, we need interest only payments, and you pay interest only for a time. Because what happens is when you don't pay on your facility for a long period of time and that interest is piling up, what is going to happen is you're going to only be stuck paying interest and nothing towards your principal. Okay. And your principal balance is the actual amount that you borrowed. So you have two particular amounts that you pay towards your interest and your principal. And in a time like this, where you lost your job, mortgage payments are due. If you don't pay something towards the interest along that time, the interest is going to compile. It doesn't matter what the system is going to calculate that payment. Your interest is going to be due, and you're going to be paying interest for a long time before that balance can go back down. So it's very important to avoid going out there and getting extra quick fix loans that can, damage your financial health. Next. I'm not sure what's next. Okay, so basically now, I guess whatever other questions that are out there, or Zemi, if you have any questions, if you see any other questions that may have popped up on the various social media sites, but
I have a few questions, but let's go back to this question. She had a secondary question
okay.
about the term. So, what about the length of time of years to pay off? So, you mentioned
Okay.
looking at the interest rate going up or down, but
Mhm.
I think she wanted to know, okay, I refinanced, my rate went down, but did they extend my term or not?
So that's a choice basically, right? So depending on your age or the facility age, right? If it's a car loan, if you refinance a car loan, it only can be the maturity date will probably not change because they can only lend based on the life of the car, the age of the car. If it's a mortgage and they base it on the retirement age. So if you have a retirement age of 65, that is the maximum age that they can go to. So if you're already financed to 65 and you have to refinance, your date will not change. Okay, the date will have to remain the same because they will stop it to the age where you're expected to stop working. Okay. So, but if
Okay.
you're young and you have flexibility and it's a short term, then they can extend the life of the facility.
Lakeisha asks, so as a first time borrower with no credit history, so she's never borrowed before, how does
Mhm.
that affect my ability to negotiate an interest rate on a mortgage? Does saving consistently over a period work to my advantage? So I think she's going to have a high down payment, but she has no credit history. So will
So,
the banks look favorably to her and negotiate with her if she has no
so
history or, yeah?
here's what. Okay, so there's two things that could possibly happen, right? Banks are always having loan sales, first of all.
Hmm.
So summertime is the best time to get a loan or mortgage at a bank most times. Okay, that's when they're giving discounts. They don't call it that. They don't call it that. They might call it a different promotion, but there are loan sales that occur at banks, and most times the summertime is a good time to get it, right? But standard, first time, second time, third time, the down payment requirement is the same,
Hmm.
20%. Now,
Mm-hmm.
that's for a residential purchase. Okay. So if I buy my first house, my down payment is 20%. The second one, if it's an investment property, the down payment increases.
Hmm.
Okay. So you have to distinguish between, you could be a first time buyer, right? But if your property is actually an investment property, your down payment would be 30% and not
Oh,
20%.
wow. Okay.
Okay. So it all depends on the type of property it is you're purchasing. If it is a residential, and residential is 1 to 4 units, anything over 4 units is an investment property, and the down payment requirement is higher. Now,
Hmm.
saving does help, but if you're a first time borrower just getting a mortgage, you really don't have a leg to stand on to say negotiate to get a lower rate. This is why the loan history, your credit history, once it started, is going to help you. So you get your mortgage and you start to pay. Between 2 to 5 years, you could start to say, hey, I only one. Or if you pay attention to the loan sales and you say, okay, they're having a blockbuster sale, you can approach your loan officer at that time and say, hey, I want to negotiate some new terms. They might say, hey, if you get a couple more dollars, if it help you to get the
Mm-hmm.
lower rate, you have
Yeah.
to find ways to negotiate those things.
And
But
also shop around. Like, you don't
yes,
have to
and if you
be
shop
perfect until
around, most
exactly.
times, 9 times out of 10, if you go back and tell your bank, hey, I've been looking around and they're saying they're offering me 6%, what y'all gonna do? And if they really, really want to keep you as a client, they will negotiate that rate, especially if you show them, hey, I've already spoken to X, Y, and Z bank, and they're telling me they're gonna offer me something better. So why must I stay here? And so that's when the bank wars start and they want to keep you as a client
Okay.
too. So you can use these things as leverage.
And thinking about a first time borrower, what are the steps that they need to take? I know number one, they need to have a life insurance. So that's something they could do prior to even approaching a bank. Because
Mhm.
I know in the Bahamas at least, you have to have life
Yeah, in the
insurance.
Bahamas, life insurance is a big thing. I was shocked when I moved here to Turks and Caicos and found that it wasn't.
Wow.
Like, it's not really a common thing here. Like, I've had
Mm-hmm.
my life insurance since I was 21 because that guy came to the bank on my job and scared me. He was like, oh, you need life insurance and lock in this rate. And I mean, I glad I got it.
Yeah.
But
Especially before that.
woo, tell me about it. But yeah, I locked in a good little sweet little rate. So, but for young people, in terms of requirements, it's generally the same, minus the life insurance, because people get that confused too when it comes to the insurances. So life insurance is for your life,
Mm-hmm.
meaning if you die and you sign that insurance over to the bank, it only means that, okay, if you die or when you die and there is a mortgage balance, that will come out of the insurance, and your family would not have to worry about paying this mortgage.
Mm-hmm.
Because from my experience in working in collections, unfortunately, people confuse house insurance with life insurance, and they're
Yeah.
saying, well, we're
Wow.
paying the insurance, and it's like, no, that's homeowners insurance. The
Mm-hmm.
homeowners insurance is for the home. And so that is in the event of hurricane, tornado,
Yeah, that's
flooding,
a good point.
the home is protected. So you either protect your, in the Bahamas, they basically advise you to protect yourself and your home.
Mm-hmm.
So in the event that you die, your kids, wife, husband, whoever is not going to have to worry about paying any hefty mortgage fees, because a lot of people, their parents died, they're in the house, the bank cannot even share the information with you because you're not on the facility. So unfortunately, the bank is also limited in what information they can even give you, even though you're in the house.
Yeah.
So you only could pay what you think the mortgage payment is, and that's only if you can afford it as well. So some people have found themselves in a difficult place where they could not even keep the home after the parent has passed away, assuming that they had life insurance.
So
Or
how do you prevent that? You are be this like I only thing I can think of is POA, but you don't randomly assign someone as POA because you don't know if I'm gonna die or not.
But
You know,
okay,
so
POA, for those who don't know, is power of attorney, and that is only relevant while the person is alive.
okay.
So you only can be power of attorney for someone if they are alive and can still sign off on things and stuff like that. Once they pass away, you no longer have power of attorney of
So
anything.
how do you prevent that situation that you talked about where I am my father or my mother died, I'm in the house and I
Mhm.
can't get the information that I need to manage this asset? Um, like especially
The
if it came over to me, I guess it would all go down to the will, etc. Making
Well,
sure that
the
I am
only way, Zemi, to prevent that is to have these kind of conversations and actually talk to your children, actually give
yeah.
them access to information, because talking about finances and mortgage is a taboo thing, especially in the Bahamas. Like everybody wants to keep their information locked up tight. Oh, okay, I'm the parent, you're the child, and da da da. But if you die now, what am I supposed to do?
Mm-hmm.
And people don't know what happens when these things happen, and the children are put in a position where they cannot, either they can't afford it, or they just don't know. The bank can't tell them, but they need the money. They still have to call the children to pay, but they can't tell them no information.
Wow, that's crazy.
So the only way to prevent that is to actually have
Have the
conversations,
conversations.
actually give access to the information. I mean, if you tell your child, okay, this is where I keep my papers, even if you don't tell them everything, just say, okay, this is where I keep my important documents. If anything happens, this is where you look for the information. I mean, as
Yeah,
simple as that, that could prevent something. And I mean,
definitely.
and then two, if you could get a small insurance that could cover a certain amount and try, see, the difficulty is managing the insurance payments, because that's something that people have to actually physically do. People always default on insurance because it doesn't come out automatically most times. You could set it up to come out that way, and I prefer it that way. But if you have to manually pay that insurance, it's probably going to lapse,
Mm-hmm.
because when people think, okay, well, I was paying insurance, okay, but if you miss 3 months, it lapses.
Yeah, I forget all the time. Mine is annual, so I forget. My
So people who
memory, I'm
pay
like, oh shoot,
monthly,
I forgot to pay my insurance. I still have it.
exactly. So people who pay
Yeah,
monthly, if you miss 3 months, that lapse, you have to start over again.
yeah. Wow,
And if you pay annually and you can't afford the annual payment anymore, it lapses.
that's another thing. Yeah.
So it's a
And we had a conversation about insurance, guys. If you want to go and look that up, and also we have a lot of ownership questions, which is great because next month we talk about home ownership all month long. I
okay.
mean, like testimonials. I'm getting people to talk about from the U.S. perspective, Canada perspective,
Yeah,
Bahamas perspective of owning a home,
yeah.
first time buyers, what to do when you're looking for a house, all of that. is
Yeah.
in the works. So if you are interested in that type of content, make sure you subscribe, follow us on Facebook, etc., and you'll be in the know for when that comes up. So I have another question here.
Mhm.
After purchasing a home, can I lower my interest rate by paying a large amount of the loan for 1 month? For example, if I have a $150,000 loan, can I pay $10,000 1 month to lower my rate after? Now this sounds like me, but I know
No,
you probably can't do that.
no. Okay, that's the thing, right? We want quick fixes, but
Yeah, this sound
really,
that's me
really,
100%.
that's not going to affect the rate. Now, what that is going to do, it's going to affect your principal balance.
Only if you tell them, right? Only if you tell them I want to
You
apply
have to
this
be
to
specific.
principal.
You have to be
Exactly. Yeah,
specific.
you have to
When
be
it comes to
specific.
making a principal payment, you have to say, I want this to go on the principal only. If you don't, they may process it as a regular payment and it could throw your loan all the way off.
Yeah, and
Okay?
I've also heard that when you're doing that, you shouldn't do auto pay. You should go in and say, this
No,
is
that
a
definitely has
principal
to be
payment.
done manually. You have to do
Exactly.
it
Face to face. Yeah. Yeah.
Most banks don't allow you to make principal payments online, or else you won't be paid off too quick. So you're not gonna be
That's
able
what
to
I
do
don't
it.
understand. You want me, you don't like when I default, but when I got it, you don't want me to pay it
Because the
off.
idea is we have this relationship for 25 years, girl. I don't want you
Mm.
to speed this up. That's not the idea. The idea is you are mine for 25 years and you
I
pay
don't want to be yours for 25 years. I want another
the
product from
idea.
yours.
So to further answer the question though,
Yeah.
if you wanted to make a bulk payment, it doesn't affect the rate. The only way to affect the rate is to be a good customer or catch a loan sale or have a good relationship with your mortgage officer. Talk to them because I find a lot of people they get a loan from this bank and they decide one day they want to get something and they for some reason it's like people feel like their mortgage officer isn't going to lend them the money, so they just go to another bank and say, okay, I want to get this X, Y, and Z, and then they have a next loan somewhere else, and then they
Mm.
say, okay, something else happened, I want them in my business, let me go to this next bank.
Yep.
So that's
That's what
how.
the credit union gonna help, right? Not credit. What's
Right.
that? That's what they call credit bureau. Is
Credit
gonna
bureau.
help.
Right,
Yes,
right, right.
because now they won't necessarily be saying what you got. They won't be like
Really?
exposing you.
That could be dangerous for the mamas.
I mean, it's time though. It's time
I
because
in the Turks and Caicos is fairly good. The banks here are they work together,
but they
so
don't know what you
things are not
have,
at
right? They just have
no.
a exactly. So all of your businesses are being shared.
Right. It's not like that. And I feel like people here have a better advantage in terms of being more financially sound because in the Bahamas it's out of control. Yes, privacy, but that credit bureau is gonna mash up a lot of people.
Yep, definitely. I'm gonna just put some comments up. So this person says we must change the mindset and have these conversations to the
Yes,
parties involved. Yes, definitely.
yes,
Person should have insurance, especially for your mortgage and also separate for your family protection. It makes a difference.
it does
There are
make it.
people who have been able to like really change the course of their whole family by having insurance. Like one
Yeah,
person passes away,
yeah,
they left a large insurance policy, the kids or the nieces
yeah.
and nephews, whoever it may be, and they can invest that money into, we talked about investment products. They could buy a property. Like insurance is a way, a method of,
It is
you know, um,
empowering your
acquiring
family.
wealth and empowering. Yeah, exactly.
If you feel like you're not making a substantial income, having an insurance is the best thing that you could do to leave for your family.
Yeah,
Even if it's only $100,000, $50,000, any amount of money that you could leave for your family would help.
definitely.
And you could think of it as a savings. You know what I mean? Like it's a savings. You may not benefit from it, but your family and the people who mean the most to you will benefit from it. So that is the reward at the end of the day. Because
Definitely,
like,
definitely.
what am
Like
I
you
paying
just say,
for?
banks don't want us to be great.
You know what? People think that, but you just have to know how to work the system. You know what I
That's
mean?
true.
At the end of the day, the banks want you to succeed because they want to succeed. The banks want to lend you money because they want to make money. So at the end of the day, if you're being declined, it's for a reason, and most times it's for your own good. because when people don't qualify, that means that they're overextended. Okay.
Yeah.
Normally in the Bahamas, Turks and Caicos, and probably the Caribbean on a whole, your total debt service ratio is 45%. Debt service ratio means the amount of money that you can owe to a financial institution, and that is the percentage of your monthly income. So if you want to calculate your own debt service ratio, all you have to do is take your mortgage payment, your personal loan payments, your visa payments, add those up and deduct it from your monthly income. And then how you get a percentage? You times it by or divide it by,
100. Yeah.
and whatever that percentage is, that is your debt servicing ratio. And as I reflected on finances, even like, I'm not in the bank anymore, but, I still get a lot of questions because I've been, with the bank for so long. And when even I looked at it, even 45% is too much.
Hmm.
It is too much of your income to be paying to a financial institution. It is a lot because when you look at, okay, the other 55% is supposed to sustain you, your children, your husband, your wife for forever. Because if you have a mortgage, the mortgage facility is not going to be probably less than 25 years. So the bank is basically telling you, we don't care what happened in 25 years. We want this $2,000 a month every month for
Hmm.
25 years.
Hmm.
But people don't look at it like that. People think, okay, this happened, that happened. Oh, the bank don't care. Well, really and truly, you agree. This is like a sad agreement.
Yeah.
So we have to be
Hmm.
so mindful when we get into these financial agreements because it is a set agreement. There's no negotiate. I mean, you can negotiate in general, but the idea is you're in the home. The expectation is the payments have to come by any means.
Any means necessary. I know all about it. Lakeisha says she's off of the credit bureau. Can't wait to have the
Oh
conversation.
my gosh, that is gonna be crazy,
But
crazy.
Lakeisha, your rate gonna be so low because you have no debt. So you're gonna have to build it up.
Now, the only thing I'm gonna say about the credit bureau is the credit bureau basically, like in the US, right? To have good credit, you have to have credit, which
Yep,
means you
exactly.
have to owe. And we don't like to owe people, right? In the
Hmm.
Caribbean, we don't like to have loans. We don't like to owe the bank. We like to pay our loans off quick and stuff like that. But when a credit bureau comes into place now, you can't have good credit if you have no credit.
Exactly. So you may have
So
to get a credit card, pay it
you're gonna
off.
have to have a credit card. You're
Exactly.
gonna have to have certain facilities to be a good customer, to have
Yeah.
good credit.
That is the
So
downside. Unless
yeah.
you decide, Lakeisha, that you're gonna buy your home all in cash. You know what I mean? Like you
And
buy,
who
you
wants
have
to
that,
do that?
you save
Hey,
up that 100K. You know, you use those investments that we talked about on Thursday. You save
yes.
up that 100K, and and then you don't have to deal with it. And then we have a question here. Okay, so what if a U.S. citizen or resident wants to purchase a multi-home in the Bahamas? Would the percentage rate be different? If so, how
So
much?
with that, because I used to do a lot of non-resident financing. So the down payment is more. So for US and Canadian citizens residents looking to make a purchase in the Bahamas or in the Caribbean, the down payment, because it's an investment, automatically the down payment is minimum 30%.
Mm-hmm.
Okay. So that means you have to come up with more money to invest upfront. Now, depending on the amount of the facility, they can probably negotiate a lower rate, but that's still subjective to their particular financial, situation. If they're purchasing 500,000 a $500,000 home or $700,000 home, obviously you have the leeway to say, hey, I need a lower rate because in the United States and in Canada, the rates are significantly lower
Yeah.
than here. So they would want the lowest possible rate that they can get. And most times the bank do accommodate when a client requests, especially if a client is a client
Is
is a
a
bit
large
more.
client. Yeah, like they're purchasing a
But it
million
doesn't
dollar home or
matter.
something.
You
Yeah.
have to ask.
Yeah.
You have to, if you don't ask, you don't receive. So the best thing to do is to ask for the best rate, and you'll be surprised. No matter how small your loan is, you could get the best rate possible.
She said over 25, give or take. You said 30%. I don't know.
Is
Can you
that,
elaborate on that question? I don't know
yeah,
what you
maybe, I don't know if that's the loan amount or the percentage amount, but for sure, um, standard mortgage rates are normally less than 10%. I mean, normally less than 10%
Yeah.
rate. Um, I've known there was a time when rates were a little bit higher, but of course, that all depends on the economy, the global economy, and certain
Hmm.
rates that the banks get their rates from and calculate their rates from.
I know some people like to have a loan with one bank, and then they like to keep all of their accounts, like their income, going to another bank. So,
Uh-huh.
especially in the Bahamas, I find that people don't want their money to sit in the same bank they have a loan with. Now, what do you think? I know, there are some reasons why people said they have experienced the bank clawing the funds to pay the loan, and so what do you think about that?
So realistically, right? The computer system is just that. It does what it is told to do.
Hmm.
Okay? And the system does not do anything well.
No emotions.
No, right?
Exactly.
So if there's a situation where payments are just coming out, obviously you have missed a payment or two.
Hmm.
If
Hmm.
there's additional funds coming out, now occasionally, once every blue moon, there could be a freaky situation that happened. It could be a mix up, especially if you have a bank with different branches with the same account numbers. There can be an error. Human error, yes. Computer error, most of the time, no. So if there's additional funds coming out that the computer generates, most of the time you probably missed something. And February is a month that can mess a lot of people up.
Hmm.
Even though it's only a couple of days shorter, sometimes February could mess people up. You could miss February payment thinking because you paid on March 1st, but you paid for February. And people get that mixed up.
Hmm. That's a good
If
point.
you missed the end of February and you paid on March 1st and you look at your system and say, oh, I paid March. You know, you didn't. You paid February. So now you have to pay March in March.
Hmm.
So sometimes people have two payments coming out in March because they missed February. So little
Wow.
things like that could throw you off. And also, I want to say, do not pay late. A lot of people think that it's just the late payment that affects you when you pay late. The interest rate is calculated daily and
Hmm.
charged when your loan is due. So when your loan is due on the 1st, but you pay on the 10th, and let's say your interest per day is $20 per day, you
Mm.
just paid an additional $20 per day that you were late for 10 days. So that's $200 more in interest. So that means when your payment is actually paid, $200 more goes towards interest and 200 less goes towards your principal. And these are
Mm.
the little things that cause your
Yeah.
loan balance to be off. And when
Yeah.
collection center is calling you because your loan is out of whack, you don't understand it because so many times you've been late and you're paying more interest than the bank actually really tell you you're supposed to pay.
Hmm.
You're paying the bank more interest. You're making the bank more money than they agreed to make off of you
Yeah.
when
Wow.
you're late
Because of your behavior, if you pay on time, you
because
wouldn't go
of
through that.
your
Yeah.
behavior. It is on you
Hmm.
because the system is going to calculate it. You're late one day. I've seen accounts where interest was $100 a day. Can you imagine being late 10 days?
Someone say, someone a comment here. Delethea said, "There's no 5 days grace." Or did I imagine?
No,
The system is the system. If the system is
listen.
coded, yeah,
Right,
I think that's the question you have to ask your banker, because if the system is coded to charge on this date, the
for
system
late,
has no
only
emotions.
thing that will be grace is the actual late fee. The
Hmm.
interest, my friend, is not going to have a grace period. That interest is calculated every day, all day for the life of that loan. So you're not going to benefit from paying late. Okay. Some people think that, oh, the bank, why they calling for this money? They don't need this money. You need this money to be paid because you're paying the bank more by paying late.
Yep. And
So,
let's talk about fixed. You talk about fixed loans. So my husband
okay.
and I, we have a fixed
Yeah.
mortgage,
Okay.
and we want to throw like additional payments on it, but there is a penalty after a certain point. So I think we could pay like maybe like one extra full payment, and after that it's a penalty.
Okay.
Now, if we're one of those people who say we don't want a mortgage for 25 years,
Uh-huh.
should we be saving money on the side and then get to a point where we pay off our mortgage in bulk and we don't care about the fees? Or you say
You can
just
do
keep it
that.
25 years? What?
I mean, okay, this is how I had to start to look at it because I was one of those. I'm still one of those. I don't like to borrow, right? Even though I was in
Mhm.
banking, like nobody likes to borrow. Nobody likes to owe. Like I don't like to owe people money, stuff like
Yep.
that, right? And I had this small balance on this loan one time. I must be had like $5,000 left to pay or something like that. And I was, talking to my loan officer at the time, and I was like, man, I don't pay this thing off, man. This little balance bothering me. And she was like, why don't you just keep your money? Just pay the loan. And I was
Mhm.
like, if you realize what it is and kind of just say, okay, this is what we committed towards this, but we could actually live a good life, you could ignore the fact that you have this facility. Because at the end of the day, if it's for the house, right? Perfect world, if you would have saved your money. So, how long would it take you to save $300,000 to buy this house? Well, it ain't gonna be 300,000 because you have to save for closing costs, um,
Mhm.
all kind of other costs. So it's gonna be $400,000. So realistically, how long would it take for you to save $400,000? The reality of that is life happens all day, every day. And so you could have good intentions to say, I'm gonna save $1,000 a month, or I'm gonna save $500 a month. Something gonna happen, and you can spend that money somewhere else, and you realize you only have $20 left, and it happens every month.
Mhm.
Right? Something is gonna be a priority, especially people who have kids or any other thing going on. Something is gonna pop up that needs your attention and your money. And so that is why the mortgage or the loan stands in the gap for that, right?
Yeah.
So you save a portion, you make the purchase because your down payment is your commitment. You make the purchase, and you just say you have to look at it as you are saving, right?
Yeah, in a
If
sense.
you can, and if it's a plan, did you say, okay, we want to pay this off in 10 years or 15 years? You can save, either decide to do a bulk payment or you can do monthly payments, but you have to check your terms, like you said,
Mhm.
because you may be able to make one or two payments, right?
Yeah.
So if
Which will
that's
cut off a couple years, maybe like a couple years on it, but definitely.
right,
My
so you
other
can do
point with
that.
that is, so if I look at my mortgage and my interest rate is like, I think ours is 4.9.
Okay,
And I could say, okay, I can't pay that off
right,
because they're gonna charge me, but I
right,
could probably invest in something. And now it's harder in the Bahamas, but you could
right.
find a possible investment that charges that or more.
Yeah,
And then that's a way you kind of, for those people who care about that kind of stuff and who are like, I don't feel good about this, it's stopping me. You could put it in an
yeah.
investment, a
You
mutual fund,
could.
etc., and then
Yes,
you could be making interest while they're
yes,
charging you interest. So
yes, because
that's
there are
something to kind of
financial.
offset for people who are concerned about that.
Yes, there are financial institutions that are not banks that offer better rates on that kind of investing, saving, and stuff like that. They have awesome rates, to be honest, because the banks' rates right now, I don't even think they do fixed term deposits like that anymore because the rates are just non existing.
Okay, so low. It almost doesn't make sense. So I have a few scenarios that I want to walk through before we end our discussion tonight,
Okay,
on the topic of wise borrowing. So number one, I am a single woman and you are my loan officer. I come to you and I say, okay, I want to, maybe let's not put you as my loan officer because you may not be a person who wants to give me this advice. Say you're my financial advisor.
uh huh,
And I come to you and I say, okay, I want to take out a loan of $20,000 because I want to purchase a car, but the car is going to be in my boyfriend's name.
okay.
What do you tell me?
First of all, what are you doing? Okay, so you have $20,000, but the car is not going to be in your name. Why?
Because it's going to be in his name. So I'm purchasing a car for him. I'm taking
Oh,
out debt for my boyfriend. So what would you tell that person before she makes that decision? What considerations should she make?
Okay, well, it's a personal decision
Mm-hmm.
to make that kind of purchase for someone who is not a spouse, right? Um, but in situations like that, though, it's kind of weird because if you're coming to the bank, is she trying? You're trying to borrow, or you just want to use this money?
She's trying to borrow. She's taking out an auto loan. So she's going to be paying this loan whether they together or not.
Exactly. Okay, so let me tell you how the auto loan works. Okay, so most times, okay, the person getting the loan has to have a driver's license. And the person getting the loan, their name most likely will have to be on the vehicle as well.
Mm-hmm. Okay, so
Now,
they stop you from doing this.
right now, I mean, not stop you, but if you're taking out a loan facility to purchase something, your name is going to have to be on it
Mm-hmm.
most times. The only time your name is not on a facility is if you are co-signing. So if he had come to the bank and say, I want to get this ride, and you gave him money for the down payment, that between y'all, right?
Mm-hmm.
And then now you're saying you want to co-sign on the loan for him in the event that he can't make the payments. Back in the day, people would do that like first time, first time borrowers that don't have credit history, and people with a more dependable credit history would step in and say, I'm co-signing on this loan. Um, she would have credit history, all right. Kind of a low for the person. But nowadays, it's a little bit more strict because you have to look at it as your debt.
Yeah, I have to
Um,
take ownership of that. So
right.
what things should I consider before I co-sign for somebody on a loan?
You have to consider the fact that you might actually have to pay this facility
Yeah.
because there have been times where I've had clients where, okay, let's say, okay, I had an old lady who she had her mortgage was fine. She didn't have no facility, and I think she went out and remortgaged her house to do something for her son. He decided to move to another island and leave her to pay the facility.
Wow.
She's responsible.
Mm-hmm.
She already paid her mortgage or whatever, but she had to pay.
Mm-hmm.
You had people who would get certain things, and if they lost their job or they're unstable, they're a first time borrower and you're stable, the bank is going to call you. And if
Yep.
your account is attached, they will debit the account. It will be no system error. Your account will be debited, and they will find the money and debit the account. And that
Mm-hmm.
this is why this goes back to why people keep their money separate from their loan. People don't, they know what they sign up for, but they don't want to be responsible. So they
Yeah.
try to separate their money to separate the responsibility. But at the end of the day, it negatively affects you.
Mm-hmm.
Because if you agree to something, at the end of the day, you're gonna need the bank at some point. And if you ruin that with with a separate situation, you could ruin your own credit history, really, you know.
Wow. Let's
So it's
pivot.
very serious.
Yeah, I agree. Let's pivot a little bit. I just had a thought about hire purchase. I don't know if you were
Okay.
familiar. I know it's not like a bank concept per se. I know like places like Furniture Plus or furniture stores may offer
Yeah.
that. Is going on hire purchase to purchase my furniture set, my bedroom set, is that a wise borrowing decision?
It all depends because I feel like in the past it used to be considered a wise decision because you have your dream home, you want to dream furniture, you want to dream house. But me as an adult now, and even having been in that industry for so long, what you dream of changes.
Oh
And I
yeah.
just had this conversation with one of my friends. Like what you think of and what you imagine, it changes. So my dream house today is not going to be my dream house 5 years, 10 years from now. So after 5, 10 years, you're looking at this furniture is either busted, disgusted, rusted, and you want to get rid of it, but you still have a loan for it.
Mm-hmm.
That's when it doesn't make sense.
Mm-hmm.
So if you're going to spend $20,000 on furniture that is going to depreciate and wear out for whatever reason, that's not a wise borrowing decision because you're going to
Especially because, sorry, because back in the day, the furniture may have been real wood,
and the
or
quality was
the quality
different,
was so much better
right?
versus today. the quality you're getting is not the same, but the
Because
price may be
the
higher.
demand is so high, they're
Exactly.
knocking these things out so quickly, the quality isn't there. And you can find reasonable furniture. I think that if the price is reasonable, it can be considered wise, because if you can pay it off within a year or two, then fine. But if you're paying for furniture more than 5 years, it's not wise, because you're gonna have to change that before the loan facility is finished.
Definitely. We have a question here. What about small businesses? The bank sees exactly what small businesses bring in but refuse to lend to small businesses. Why is that?
This one is this in my heart right here. Small businesses. I feel a particular cut in my heart for small businesses because I have a small business. Um, Here's the thing though. There are some small businesses that do the right things, and there are a lot of small businesses that don't do anything. So
Mm,
the only way to leverage your business, you have to show proof of the money that the business is making. So, showing proof is depositing your money no matter what. If you don't understand how to use QuickBooks or any other financial statements, write it down in a journal, but you have to deposit the money. If the money isn't deposited, it was not made in the bank's eyes. Okay, because gone are the days where you could say, well, I made $100,000 last year, and they would take you at your word because of certain things, but you have to show that you made that $100,000. And the only way to show that, that has to run through that bank account. And that's why the bank asks for 3 years bank statements for businesses, not only to see if the money is deposited, but to see the trends, to see
mm,
the activity, to see if you're getting regular deposits, if you're
mhm.
depositing every day, every week, every month. Because if you're depositing once every 5 months, thing is saying, now hold up now, what kind of business is this? Like, or is it
Yeah.
seasonal? Can you explain why you're only getting one deposit every few months? Like everything is explainable, and the bank account shows everything that the bank needs to know, whether you tell them or not. So depositing the money, if you don't do nothing else, I cry out to small businesses, especially people who are sole owners. They are the biggest culprits of not depositing their money on their business account. And you can't commingle your funds. Now,
Mm-hmm.
yes, you can have your bank account card or whatever. I don't see anything wrong with swiping the card, but you need to deposit the money to the business account first. um and that's the kind of thing that makes it hard for the small businesses to be taken seriously, but every situation is looked at individually. So it's not going to be a blanket thing, okay, all small businesses don't do this and don't do that, whatever. If I'm looking at your company now, we have to look at the 3 years activity. And unfortunately, when they're looking at the financial statements, it's not like someone who gets a base salary, right? So if I've been working for 15 years. Let's say I'm making $100,000 a year. They could see that on my job letter. It's confirmed. They can see it in my bank account. Fine. Boom, 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 boom. That's it. A
Mm-hmm.
business, the term it's based on the activity, your clientele. So they're gonna analyze each year. The worst part about it is if your income is not consistent on the 3 years, they use the lowest income year to qualify your business.
Oh, wow.
So a lot of businesses right now, everybody's lowest income year is probably going to be 2020.
Mm-hmm.
And
Well, not
that
all.
means,
Apparently,
well,
some are.
not all,
Yeah.
but a lot of people, some
Yeah.
maybe, some people were blessed during the pandemic, but a
Mm-hmm.
lot of people, their lowest financial year maybe 2019 or 2020.
Mm-hmm.
And so that is going to be a disadvantage for a lot of businesses, because if they want to get financing, the bank is going to use your lowest year income unless you had a substantial 2020 and it didn't affect you, because right now they'll be asking you 2021 won't count. So they'll be asking you for 2020, 2019, and 2018 financial statements or bank statements to qualify your business for a loan.
Mm.
So if you don't have a steady income on your business, they're going to use the lowest year income, and that's always the standard.
Okay. So hopefully that helps you, Chris Kashanti Hall. I hopefully that helped you. If you have a follow-up question, please ask it. I have two more questions. I don't know if anyone else has a
Okay.
question, but number one is again, I am single, not married,
Mhm.
and I am considering purchasing a property with my boyfriend, not engaged yet.
Okay.
Should I do that or should we hold? What are the pros and cons of each?
You can, but the problem is because there's no commitment between you two, that's going to be a personal thing if you two decide to break up because both of you will be responsible for the mortgage whether you decide to stay together or not. And those situations are always hard because some people break up before the process is finished.
Mm-hmm.
Some people make it through. Now, here in the Turks and Caicos, we don't get in people business like that in terms of boring with your boyfriend, all this stuff. Like, if y'all two come to the bank, y'all have the requirements and stuff, that's fine. I think in the Bahamas, though, it's a little bit different because they, a lot of times, you know what? You know what the standard is? I just remember the problem with girlfriend and boyfriend borrowing is each of you have to qualify individually for the
Mm-hmm.
facility because in the event if y'all break up, one of y'all have to be able to pay the whole thing.
Yeah, wow.
So that is the disadvantage when you're not in a marriage relationship. The qualifications is okay, if you're getting a $300,000 house, each of you have to qualify for the 300,000.
Mm-hmm.
So in the
Wow,
event
I
of
didn't know
two
that.
people have to leave, then Joe could pay.
Now, I want to pivot to married couples.
Mhm.
Obviously, we're not walking into marriage thinking we would get a divorce.
Right.
But what is a wise way to borrow as husband and wife that protects both of us in the event there was a demise? So, for example, should both of our names be on the home? Like stuff like that. What should we be doing to protect both of us when we're borrowing?
That one is kind of hard because you know why? It would all depend on what is important to you as an individual. Some people, it's always best for your name to be on it, especially if you're going to be responsible for paying. um it could be a disadvantage if you love the house and at the end of the day your name is not on the property and you have to leave or whatever, but most times the court will make a decision on that matter in terms of who would get the house, who would have to pay out who and stuff like that. That part is kind of decided in court. um
Mm-hmm.
in terms of initially, like you say, initially people don't intend to break up. Sometimes some people cannot qualify, so their name is not on the mortgage, but your name can be on the property. It doesn't have to be on. I gotta be on the property. You can have the mortgage. I remember my name be on the property. Okay, so
Yep.
make sure your name is on the property. Not necessarily the mortgage facility, but even if your name is not on the mortgage, you're not getting away scot-free because if he decides to leave the home, the bank is calling you to pay because you're in the house.
Yeah.
So whoever's in the house is responsible for the payments until you get your divorce settlement sorted out and all that stuff. So whoever leaves the house, they don't have leeway per se, but the bank is more lenient with the person that actually has to move and take on other responsibilities. But if you're in the home, you're ultimately responsible to make sure some sort of payment is paid, even if you only pay half.
Mm-hmm.
I would advise you just pay your half if that's all you can afford. Pay something. You don't want to lose the house just because you're upset with your spouse or whatever, because you may reconcile and that could cause everything to be messed up. So at least try to meet whatever obligation you can in the event of a quarrel or
Yeah,
whatever,
that's
because you
good.
never know. People can make back up.
Definitely. And I hope and that is really a great point. I hope people hopefully you never get to that point in your
Hopefully not.
relationships. But
Hopefully
if you
not.
do, don't act in spite.
Right.
You
You're
know,
only
no,
going to spite yourself. You're not fighting the
exactly.
bank.
Exactly. So that's everything from me. I don't know if we have any more questions. But I just want to thank you so much. This was a great
Thank
discussion. I had
you.
a great time. I know
Yes.
we got off a little late, but as I
Yes.
thought it would be, it was an excellent discussion. And
Yes.
hopefully we can get you back on again when we talk about home ownership next month. So I'll talk to you about
Okay.
that.
All
So
right.
thank you everyone for joining
Thank you,
across
everyone.
Facebook, across YouTube. Please, even if you watched on Facebook, please go and subscribe to our YouTube channel. We're trying to grow our YouTube channel to 1,000 subscribers this year. Please help us to make that possible. That
Yes.
is how you can sow into the ministry, and that is absolutely free. So, again, thank you so much. And what about where they can get in contact with you to, if they want to just follow you, keep up to date with what you're doing, etc.?
Yeah. So, in terms of matters like this, they can follow me on Instagram at All In with Arlene. So that's ALLWITH ARLENE. And I also have another business page for beauty stuff, and that's Arlene underscore kiss and makeup for all those who are interested in that kind of stuff. That's my main page. But for this kind of stuff, personal stuff, or any other kind of questions, they can reach me at All In with Arlene.
Awesome. So we have Talia said, critical information. Thank you,
You're
Arlene.
welcome.
Rose said, great job. Are we on every week? We try to be. We try to be. The date fluctuates, though. I'm going to try
Yeah.
to be more consistent with that. But the day of the week fluctuates. But we do have something at least once a week. And then Tiffany Brennan's gave a round of applause. So again, thank you, everyone. Have a blessed night, and I'll see you next week. We have one on Sunday, same time, where we discuss retirement planning as we close out our personal finances focus of the month. Have a blessed night. Bye.
Bye.